Okay, now this is something that young folks seem to be interested in as of late, and I don't think people talk about it in real terms so they understand how this works. So I wanted to give you the secret to successful socialism, and it can be successful, and I'll tell you when and how. So here's the original founding thought of socialism. From each according to his ability, to each according to his need. Does that sound cool? That sounds nice and friendly, right? We're gonna help people out, and these people who have this great ability are gonna help these people. That all sounds good. We also need to recognize, though, that nothing can be consumed that hasn't been produced. Can we agree with that? Nothing can be consumed that hasn't been produced. Okay, now here's where the problem comes in. Natural selection. How many of you know about evolution and natural selection, right? Okay, so natural selection says that the reason that you are here today is because a whole string of people back through history made decisions that made their genes more likely to get passed on. Does that make sense? Okay, in most times, paying attention and feeding your own baby first is a better bet. And so most of us end up with this individual bent. In order for this thing to work, though, we have to have a group focus. So the people have to be focused on not their own interests, but the interests of the group. Does that make sense? Okay. Now, if we've got this situation and people are not group focused, eventually what's going to happen to each of these groups? Well, first of all, the people who are identifying their needs, if they're not paying for meeting their needs, what do you think is going to happen to their stated needs? When I was paying for it, I needed a Volkswagen. Now I need a BMW. Does that make sense? Because that's so. And if you can't imagine this, just think about buying a car for yourself versus your parents buying a car for you. Are they different cars that you picture in your head? Undoubtedly they are, because this is the agency problem, right? Now, on the other hand, you've got these people. Oh, for shame. She's late. She told me she'd be late. On the other hand, we've got these people up here. And if they're not focused on the group, what do they start to do? They're like, wait a minute. Why should I work so hard to produce all this stuff when I don't get to keep my stuff, right? And so what happens is production goes down, but the desired consumption goes up. And you end up with shortages. And if you guys aren't old enough to remember it, but back during the Soviet Union, they had bread lines, and people would line up for hours and hours, and it's still happening in Cuba and Venezuela, all sorts of places where they're trying the system, you know, shortages. Now, I promised you I would tell you the secret to successful socialism. So here it is. You need to have three things going on. Number one, you have to have an existential threat. Why is the existential threat necessary? That's what's necessary to get people to focus on the group rather than the individual. We're more likely to survive this existential threat if we hang together. Does that make sense? Number two, a common belief. Typically religious, sometimes just political. And number three, it has to be voluntary. If you force the productive people into the system, do you think they're going to continue to produce at the same level? No, it's got to be voluntary. Okay, now, let me give you two examples where this worked out. Number one would be the early Christian church. They were under persecution from Rome, they were being fed to lions, and they knew that they needed to stick together as a group. And they actually did live out this ideal. Number two, Israel following the Holocaust. They had two groups of people that were trying to wipe them out, and they got into what's called the kibbutz system, which is the same idea. Now, here's what you need to understand, though. How long did that last? Not very long, only until the existential threat goes away. Does that make sense? Because if you look at the majority of Israelis today, not on kibbutz. Majority of Christian people today not living in a commune-type environment. And so that's what is the secret to successful socialism. Ask yourself if these three things exist in your little situation, and if they do, voila, there you go. We're good to go. Do we have these three situations in the United States today? I can tell you we don't have this one, right? By the way, common belief for the early Christianity, common belief for the people in Israel, they'll have common ethnic Judaic background. We don't have that. Do you think you could get everyone to volunteer? No. And you could make arguments about this one, but really the situation does not right now bode well for successful socialism. Any questions? Okay. Why does capitalism work? It depends on your greedy little heart, right? And you guys know deep down that people are scumbags. And so capitalism is a system that harnesses our scumbaggery for us to advance as a human race. Now, you could tell I'm a finance professor. Of course I'm a capitalist, right? But I needed you to understand that there is a situation where that does work. Okay, now let's get back to the balance sheet. Last time, I believe, we had covered all of the liabilities, and we were on to the equity. And we have basically two kinds of equity here. We have preferred stock, and then everything below preferred stock has to do with common stock. Let me say that again. Everything below preferred stock has to do with common stock. So if I were going to look at the market value of the equity, the market value of the common stock here, what I would do, or not the market value, the book value, I would take everything under preferred stock and then work with those numbers. Now, preferred stock we're not going to mess with. Common stock and capital surplus. If I want to know how much the company has brought in from issuing shares, what I have to do is add those two numbers together. Let me say that again. If I want to know how much money the company has brought in, I have to add those two numbers together. And here's why. Stock has what's called a par value. Stock has what's called a par value. In this case, it's $1 per share. If I went out and sold shares for $15 per share, $1 of that would go to common stock, $14 would go to capital surplus. Anything over and above the par value that I sell the stock for, that is in capital surplus. So in order to figure out how much common stock has been issued, I always have to add those two numbers together. Now, the other thing you need to know is these numbers are not dependent on the market price of the shares. Probably totally different. In fact, we would hope that the market value of the shares is higher than the book value of the shares. So this is how we figure a market to book value. Okay, so let's work down through here. Accumulated retained earnings. That is where we have our previous addition to retained earnings. This is money that the firm has earned but has not yet paid out to the shareholders. And you can look at the difference between 2013 and 2014 there and see that they must have had an additional 43 in addition to retained earnings. By the way, can accumulated retained earnings go down?
No.
Yes. And here's how. If the net income is negative, then the addition to retained earnings will be negative. Or even if the dividends are higher than the net income, then the addition to retained earnings will be negative. Typically, is it good to see a firm's accumulated retained earnings going down? No, that's a sign that they're losing money, right? Now, would a firm ever pay a dividend greater than its net income? And the answer is yes, and here's why. Dividends send a very strong signal to the investing public. If I want to signal that our current troubles are merely temporary, I keep paying the same dividend, even though I haven't quite earned that much money. That would be negative addition to retained earnings. My accumulated retained earnings would go down. But is that a game I can keep up forever? No. Okay, then we have less treasury stock. By the way, when you see the word less in accounting, what does it mean? Minus. And so this is actually stuff we're subtracting out here. Now, what's in the treasury stock account? It is shares that the firm has repurchased, shares at the firm has repurchased. And that represents the actual amount of money that has been spent repurchasing shares. And so when we go from 20 to 26 on the treasury stock, it means we have repurchased an additional $6 million of shares during the year 2014. Why am I using an old balance sheet? Because they simplified it in the later versions and they've left some good stuff out. Okay, now if I add all that together, I get my total equity. By the way, if I want to figure out the common equity, the easiest way is to take the total equity minus the preferred. The total equity minus the preferred will give you the common, the book value of your common equity. Oh, for shame, he's late. Okay, now notice there are some footnotes down there. A lot of information in financial statements will be in the footnotes. And in fact, some financial analysts would tell you the footnotes are actually more important than the financial statements because they talk about all the jiggering that people did to make the numbers come out the way they did. So footnotes are important. Let's talk about book value minus market value. Everything on the balance sheet is in book value. Everything on the balance sheet is in book value unless the problem says a market value balance sheet of the firm says, then those are market values. Now, where do book values come from? For assets, it's historical cost minus the accumulated depreciation. We talked about that last time. The market value is the amount you would receive if you sold your asset. Most of the time, book value and market value are not the same thing. When I inherited my business in 1997, all the equipment had been depreciated out. If it was totally depreciated out, what was the book value of my equipment? Yeah, zero. However, I could have sold my least valuable machine for $50,000. That's the market value. The book value was zero. I could have sold my most valuable machine, for $350,000, even though it had a book value of zero. So do not get confused between book value and market value. Is it possible you could have a positive or a book value that's greater than the market value? Absolutely. Think about the machinery that's needed to make semiconductors. That stuff gets obsolete so fast that your true reduction in value will outrun the depreciation on the machine. Questions?
When we said we can have negative retained earnings, are we going to have to borrow debt to repay those?
No. So when the firm loses money, right? And so we have negative net income. And so we know that net income is equal to dividends plus addition to retained earnings. If we don't pay any dividends, just assume we don't, that means that addition to retained earnings has to be negative. Now, just because you lose money, does that mean you're necessarily out of cash? No, so don't think of it that way. In fact, we know net income isn't truly cash, is it? Yeah. No, you're not going to have to run out and borrow money. Eventually, though, if you keep this game up, you will. And we'll get into why going out there and borrowing money or issuing additional shares sometimes sends a bad signal to the market, but we'll get to that in a later chapter. Good question. Other questions? Okay, now let's talk about net working capital. Current assets are things we expect to produce cash within. Current liabilities are things we expect to consume cash within 1 year. So very much so, we want net working capital to be greater than zero. But even if net working capital is greater than zero, is that a guarantee that we'll have enough cash? I'm asking you, Mr. Tibbs. No, why?
Because there might be unable obligations.
Okay, so let's think about this. And the question is why? Current liabilities. Pretty damn sure I'm going to have to pay that money, right?
Right.
Current assets. Do I know for sure that my customers will pay? No. Do I know for sure my inventory will sell? No. And so you could have a net working capital greater than zero and still find yourself in a world of hurt. Now, if I find myself in a world of hurt, what can I do? I can't borrow in the short term and boost my net working capital because it's going to boost both the cash and the current liabilities, and those will wash out. So what I have to do is either I have to go out and issue long-term debt and put the money in the checking account, or I have to go out and issue shares and put the money in the checking account. That's how I take care of a predicted negative net working capital situation. Does that make sense? Okay. And that's all about the balance sheet. Now we're on to the income statement. Income statement captures over an entire period. The thing at the top will have many different names. This one says total operating revenues. It could be total sales. It could be net sales if you're a retailer. And then the next thing under that is the cost of goods sold. That is everything it costs to put this thing into our inventory, cost of goods sold. And then we have selling, general, and administrative expenses. These are expenses that I can't tie directly to the product. The CEO's salary, the receptionist's salary, the copy paper, the office supplies, that sort of crap. That's all in selling, general, administrative expenses. Now, what else goes in there? Salespeople's salaries and salespeople's commission. And if you find that your SG&A is too high, maybe what you want to do is clamp down on the spending, like Bob in the steakhouse. Remember Bob with the huge bill? Okay, that was SG&A, right? Clamp down on that. But do you want to cut your salespeople's commission? No, why not?
They'll leave
They'll leave, right? And by the way, what will they probably take with them?
their clients.
Yeah. Hey, you might not have heard, but I'm now with XYZ. We do so much better than ABC ever did, right? They'll take the customers with them. So you don't want to cut their salary, you don't want to cut their commissions, but you might rein in their travel and their travel expenses, that sort of stuff. Then we have depreciation. By the way, is depreciation an actual cash expense?
No.
No, we already spent the money on that machine long ago, right? And so this isn't an actual cash expense. And so when I subtract all that stuff out, I get operating income. And then I've got other income. If I sell a machine for more than its book value, that extra would go into operating income. If I win a lawsuit, that money would go into other operating income. Conversely, if I lost a lawsuit, guess what? Negative other income. Does that make sense? Okay. And then we can subtract the earnings before interest and taxes. You can guess the next thing we're going to do is subtract out our interest expense. And the reason we subtract out our interest expense is because interest is tax deductible. We're subtracting it out now to get our pre-tax income. And then we figure out what the taxes are. Now, remember I told you about the two ways to deal with depreciation, straight line and the modified accelerated cost recovery system? According to straight line depreciation, my taxes should be $84 million. But because of accelerated cost recovery, I am only having to pay 71 of that now, and I'll have 13 that I pay later. As a result, that deferred tax, that is another non-cash expense, right? Because that 71 is actually flowing out in cash to the government. That other 13 is not. We'll have to pay that later. So I can calculate what is the net income by subtracting my taxes, and then we know that that net income flows into additional retained earnings and dividends. By the way, here it's split 50-50. Does it have to be like that? No. In fact, if you're a growing company, you're likely not paying any dividends at all. Why? Because you want all that money to go into additional retained earnings, to go into accumulated retained earnings, to become internal equity to continue to grow the firm. What if you're a no-growth company? How much should you be retaining?
100%.
If you're a no-growth,
Yeah.
you should be retaining 0 and paying out
100%.
100%, right? Does that make sense? Okay. Let's see. So we've got all these situations where this income statement is not exactly cash. And so we've got, when you sell something, it's going to show up in the top line of the income statement, but we might not have gotten cash because instead we've received an accounts receivable. And when we go out and buy something, we might not have had to have spent cash because we might have instead developed an accounts payable. The cash hasn't gone out yet. And depreciation, we know, doesn't consume cash. Deferred taxes don't consume cash. And so we're going to have to make some adjustments here to get between the income statement and cash. Now, before we get into that, I want to show you, stop that. I want to show you how these things link up. I want you to notice that, let's start with depreciation. Depreciation of 90 on the income statement. Take a look at the depreciation on the balance sheet, the accumulated depreciation. It goes from 460 up to 550. What is 550 minus 460? 90. These numbers must match. If they don't, you've got a problem. Also, let's see what else we've got here. We've got deferred taxes. Deferred taxes of 13. If you look over here, under long-term liabilities, deferred taxes, we go from 104 to 117. What's 117 minus 104? 13. Has to match. If it doesn't, you've got a problem. And finally, I want you to look at the addition to retained earnings. On the income statement, it says 43. If we look at accumulated retained earnings, it goes from 347 to 390. What's 390 minus 347? It's got to be 43. If it's not, you've got a problem. Questions? Okay. Now, do I really need to tell you guys how to figure taxes? The only thing I want to point out to you is that these brackets show that there's a $3 in between each bracket. Do you think the government's going to let you get by with not paying taxes on that dollar? No. And so the bottom of that second bracket isn't $50,001. It's 50,000, comma, or 50,000.01, right? So there isn't a single dollar that's going to escape being taxed by Uncle Sam or whoever your government is. Now, let's talk about the difference between the average tax rate and the marginal tax rate. If we have a pre-tax income of $200,000, can anyone tell me what the marginal tax rate's going to be? By the way, what's the definition of marginal tax rate?
The tax rate on the additional income.
Yeah, that's the tax rate that you're going to have to pay on the very next dollar earned. And so what we're going to do is figure out what bracket 200,000 is in. I think it's in that 100,000 to 335,000 bracket. And that bracket is charging us, what, 39%? So my marginal tax rate is going to be 39%. My average tax rate is just going to be the total tax that I owe, and we're going to calculate that using this bracket, divided by the taxable income. That's going to give me my average tax rate. Now, for making decisions, which do you think is more important, the marginal tax rate or the average tax rate? Yeah, it's the marginal, and here's why. Any project I take on, I'm hoping is going to provide me profit in excess of whatever it is that I'm currently doing. Does that make sense? And so that means that I want to start with that next dollar as my marginal tax rate, and that's going to be what I'm going to be using for my decision-making process, because after all, any profit I make on that new project, the government's going to hit me for 39%. Okay. And does this work for you personally? We, in the United States, individual income taxes look much like this, right? And so when the university asked me, do you want to teach an extra class, do I look at my marginal tax rate or my average tax rate to figure that out? I look at the marginal because it's going to be on top of my current income. Okay. That's that for the income statement. And now we're on to cash flows. Okay, first we're going to talk about finance cash flows, and then we'll talk about accounting cash flows. Okay, think about the balance sheet. We've got assets over here, and they're producing cash. And that cash flows to one of two places. It's either going to flow to the debt holders or the shareholders. And so that's how it's supposed to work, right? The cash is supposed to be created by the assets, And by the way, those are the two groups of investors at the firm, right? The bondholders and the shareholders. Okay, so how do we figure out this cash flow to creditors or bondholders? It's, by the way, do you think interest is a cash flow to bondholders? We're paying interest to our bondholders. That would be a cash flow to the bondholders. So interest is very definitely there. But we want to subtract out any new debt. We want to subtract out net new debt. And it's in a particular way, it needs to be long-term debt. The most common mistake here that students make is to use total debt instead of long-term debt. Now, if you want to know why we only consider long-term debt, I have done a mathematical proof and saved it in the chapter there. You can go look at it to prove to you that it needs to be long-term debt and not total debt. And so basically, we're taking interest minus the net new debt, because after all, net new debt would be a cash flow from the bondholders, and that's why we've got a negative sign in front of that net new debt. Then similarly, we have our cash flow to shareholders. First cash flow we think of to shareholders are the dividends. My dad loves to get those checks in the mail. Now, we need to subtract out the net new stock. So we need to figure out how much stock we sold. And then we need to subtract out how much stock we were purchased. And that net new stock, of course, is going to have a negative sign on it, because if it's new stock, that's cash flow from the shareholders, not to. So that's why it's got to have that negative sign on it. Now, it gets a little hairy here. Remember, we said that you can tell how much stock a company has sold by adding those two accounts together. What were they? I'll give you the hint. First one's common stock. Second one was capital surplus. Capital surplus. So we're going to take that, and if you issued new preferred stock, it would also be in there, right? But you would take those two things, add them together for the last period, subtract the sum of those things for the prior period, and that would tell you how much new stock was issued. Now, how do I know how much stock was repurchased? Which account did we say it shows up in? Yeah, treasury stock. Treasury stock. So we went from 20 up to 26. Therefore, we have 6 repurchased, and so we would have the amount sold minus the amount repurchased. Okay. I don't want to point, I'm not going to walk through all of this, but I will point some things out to you. The 43. We've got 43 in dividends, and we also happen to have 43 increase in common stock. Is that required, that those numbers be the same? Absolutely not. And in fact, it's kind of squirrely that they would be. Why would you go out and sell $43 million in new stock and just turn around and pay a $43 million dividend? It doesn't make any sense, because when you go out and sell stock, you have to pay what's called flotation costs. And so there's actually destroying shareholder value if you did that. It's just a goofy example, so don't let that throw you. Now notice when we put this cash flow to bondholders and cash flow to shareholders together, we get 42. And we're going to see that number again here in a little bit, because it turns out we can also find our cash flow from assets with this formula. And so you can actually think of these two formulas being hooked together. They're the right side of the first one and the right side of the second one, you could put in equals because of transitivity, right? And this side is equal to operating cash flow minus net capital spending minus, what's the triangle mean? Change. Minus change in net working capital. Okay, so let's talk about net capital spending. What you want to look at is your ending net fixed assets, subtract out your beginning net fixed assets. But you have to add back depreciation. And here's why. Remember, we're subtracting out accumulated depreciation. That depreciation's gone up 90 between those 2 years, and it's a non-cash thing going on there, so we need to add it back. And so that's going to tell me my net capital spending. Then my change in net working capital. That one's easy enough. I just figure out the net working capital for the later period, subtract out the net working capital for the prior period, and that tells me my change in net working capital. And we have operating cash flow. We have EBIT, but we add back depreciation because after all, depreciation is subtracted out before we get to EBIT. And we're going to subtract taxes because after all, taxes are a real cash flow. Now you may say, why do we not also subtract out interest? And the answer is this. Accountants think of interest as being an operating expense. In finance, we think of it as a financing expense because after all, it's money that I'm spending to finance, right? Just like dividends. And so when you see finance people talk about financing costs, we will include dividends and interest. Accountants will think that interest should be up in the operating expenses. Okay, so we can throw everything in here, but something I want you to pay attention to. Look at this, you got 219 of EBIT, you've got 90 of depreciation, but only 71 of taxes. What were our taxes on that income statement? 84. Why didn't we include the whole 84?
13 were deferred.
Yeah, 13 of it is deferred, right? So it's only the current portion of taxes we subtract. Let me say that again. It's only the current portion of taxes we subtract when calculating operating cash flow, because after all, those deferred taxes are a non-cash expense. Okay, so I can go ahead and figure out I can take my operating cash flow and subtract my net capital spending, subtract the net working capital change, and that gives me 42. Do you recognize that number? Yeah, it's the same number as previously. And if it's not, you've done something wrong. Most common mistake, including the total tax amount instead of just the current tax amount. That's the most common mistake that students make here. Questions? Okay, now, accountants, they have trouble with the whole concept of cash, but they realize that this isn't quite right. And so they come up with this third statement to let you know what the true cash flows of the firm are, and it's the accounting statement of cash flows. And the accounting statement of cash flows starts with net income and then makes corrections to get to where we need to be to understand what the true cash position of the firm is. And so they're going to be making some changes here, and they put them into 3 sections. Now, they have cash flow from operations. Not the same as our operational cash flow or operating cash flow that we figure in finance. Not the same thing, don't get confused. And the difference is interest, right? Then they have the cash flows from investing and the cash flows from financing. Okay, so let's take a look here. This is getting really kind of busy, but let's go. So we've got the income statement over here, and we've got our statement of cash flows. Notice that we're starting with net income. That came from the income statement, and then we instantly add back depreciation. Where did the depreciation number come from? The income statement, right? So we're going to add that back. Why are we adding it back? Non-cash expense. Okay, now so far that's the easy part. Oh, we also add back our deferred taxes. Why are we adding back our deferred taxes? Non-cash expense. Both of these things were subtracted out from net income, but they're non-cash expenses, so we got to add them back. Now things get kind of hairy when we start looking at changes in current assets and liabilities. So, accounts receivable. If accounts receivable goes up, let's run it the other way. If accounts receivable goes down, what happens to your cash? It goes up. And so these are always going to work in opposite directions. If an asset goes up, your cash goes down. If an asset goes down, your cash goes up. Example, you go out and you buy a new car for cash. What happens to your assets? They go up. What happens to your cash? It goes down, right? Okay, so that reduction, that actually means accounts receivable must have gone up by 24. How can I prove that to you? Look at the balance sheet. Accounts receivable went from 270 up to 294. That's a gain of 24. So far, so good. Inventory. Inventory is another asset. If my inventories go up by 11, What happened to my cash? Went down by 11. This is how you think about these things. So we know we've got a positive 11 here. It means inventory must have gone down. Inventory must have gone down, right? And if we look, our inventory fell from 280 down to 269. If you sell inventory, your inventory goes down, your cash goes up. If you go out and buy stuff to put on the shelf, your inventory goes up, your cash goes down. And that's the way it is with all these assets, is they move in the exact opposite direction of cash. Now, what about liabilities? Well, if I go out and borrow $100 from a friend, what happens to the level of cash in my pocket? It goes up. What happens to my liabilities? They go up. So liabilities look like this. When liabilities go up, cash goes up. When liabilities go down, cash goes down. If I pay off a debt, what happens to my cash level? It goes down. What happens to my liabilities? It goes down too. Does that make sense? And so we see here, we have positive 31 from accounts payable. That means that our accounts payable must have gone up by 31. And if we see 486 minus 455, we see that it did go up by 31. So that's how those things are all linked together. By the way, do I have to have all three of these statements? Do you see how they're all connected? If they're not connected like this, there's something very wrong, right? You need to go back and check your work. Okay, so that's going to get us our total cash flow from operations. Total cash flow from operations. Now, if I were a finance person, I would say that's not correct because interest is missing from there because interest has already been subtracted out of net income. Interest shouldn't be there, it should be in financing, but that's not how accountants see things. Then we have our investing activities, where this is where we're going out and buying new plant, property, and equipment or other stuff, and we're selling old. And so if you look at the difference between those, that's going to be your cash flow from investing activities. By the way, cash flow from investing activities, typically negative. New machines cost more than their trade-ins are worth. Does that make sense? When you go to buy a new car, usually what happens is they give you a trade-in amount for your car. It's going to be smaller than the price of the new car, right? And so your old car goes out with a smaller value, your new car comes in with a greater one, and so your investing cash flow is negative because it's net cash flow from investing, right? Okay, and if we look here, we have sold 198, or we sold 25, but we went out and purchased 198. If we add those numbers together, we get minus 173. That's the cash flow that's going out for our investing activities. Notice that is the same as our net capital spending. This is something accounting and finance agree on. That's the same as our net capital spending. That's the same number. And then we have our financing activities. Financing activities. So we're talking about stocks, bonds, that sort of stuff. And the first thing on there is the retirement of long-term debt. What does it mean to retire debt? Pay it off, right? And when we do that, what's it going to do to our cash? It's going to go down. And so if we look at retirement of long-term debt, it means that our long-term debt should have gone... Oh, so we've got retirement of long-term debt, and then we've got proceeds of long-term debt sales. And so we're looking at a net new debt situation here, right? Does that make sense? Now, so we have gone out and paid off 73, but we borrowed 86 more. What's the net? 13, right? So we went out and borrowed 13 more than we paid off. And if you look at our long-term debt, it went from 458 to 471. That difference is 13. Now you might ask, why in the world would they go out and borrow 86 million and pay off 73 million? Why not just borrow 13 million? And the answer is called refinancing. And there are two reasons we might do it. Number one, old debt is maturing and we need to replace it with new debt. Or number two, like I do on my mortgage when interest rates are low, I am refinancing higher interest rate debt with lower interest rate debt. So that's why those numbers might look the way that they do. Then we have dividends. Dividends are always a cash outflow. It never will say plus here. We spent $43 million on dividends. That money is gone. We've repurchased $6 million in stock. How do I know we've repurchased $6 million in stock? $26 million in treasury stock minus 20 from the previous period tells you that we've repurchased an additional $6 million in stock. What did that do to our cash? You will never see this going the other way. This repurchase of stock will never be positive. Proceeds of new stock issue, that's the money we brought in from selling stock. Of course, when we sell $43 million of stock, that increases our cash. And so the sign on that is positive. You will never see a negative on proceeds from new stock issue. When I add all those numbers together, I see that I've got $7 million in total cash flow from financing activities. And if I add all these numbers together, 207 minus 173 plus 7, I see that my change in cash should be 41. So I have produced 41 million more in cash than I've consumed. And where should that show up on the balance sheet? Under cash and equivalents. And we see it went from 157 up to 198. What's 158 minus 157? That's 41. That's got to match. If it doesn't, you've done something wrong. Okay, so all three of these things have to match. Oh, and by the way, notice here on their financing activities, did they mention interest? No, because for accountants, the interest is mentioned up in the operating cash flow, or the cash flow from operations part. Questions?
Where is that interest? I don't see it.
Exactly. It's hiding. You know where it's hiding? In net income. It's already been subtracted out, right? We didn't add it back. So it's hiding. Good question. Okay. My goal is not to teach you accounting today. My goal is to let you know that you don't know accounting, so you'll actually do the review like I asked you to. Hopefully you guys did though, because you did homework too, right? Okay, now I am going to jump into some chapter 4 stuff here, but before I do, I want you to get your calculator out. Get your calculator out. Get your calculator out. And we are, as a group, going to do the calculator purification ritual. I don't know what's happened to your calculator since the last time you two were together, but sometimes things happen and the calculators lose their minds. Plus, your other professors may have told you stuff that was totally bad. We're going to clear out your calculator so it will work for you. So, here we go. Are you ready? Okay, I know you're excited. Hold your excitement. Okay, here we go. We're going to hit second, which is the yellow button. That's like a shift key. And what it allows us to do is access the stuff that's above the buttons. Look down here where you see the plus minus. What does it say about the plus minus? Reset. So I'm going to hit plus minus, and it's going to say reset, and that's supposed to be a question mark. I know there's no dot. Please just bear with me. Okay, now, if we're going to reset this thing, it gives us a hint how we should do it. What button should we hit? Enter. Where is enter at? Yeah, it's on the top row right next to CPT. Now, we have reset the calculator to the factory settings. But there's one more change we need to make. And that is we need to change the number of decimals that are visible. And if we do this, what we're just going to see is 2 decimal places. If I say second, and then I hit the decimal point, notice it says DEC equal 2.0. That means 2 decimal places. If I want to change that, what I'm going to do is hit 9. By the way, 9 is what I want in there. 9 and hit enter. 9, enter. And that should change it. Now, when you get back to your regular screen, you hit clear a couple of times, now you should just see a 0. Because in decimal equal 9 mode, it only shows the decimals that exist up to 9. In other words, if I say 1 divide by 2, it's only going to show me 1 decimal place because that's all that exists. If I say 1 divide by 4, how many is it going to show me? 2. And if I say 1 divide by 8, what's it going to show me? 3. What if I say 1 divide by 7? It's going to show me 9. And by the way, is that the end of 1 divided by 7? No, that crap just goes on, right? And so that's why we're using this special decimal mode, is so you can see what all is out there, out to 9 decimal places. You say, why would it possibly matter? In finance, we're looking at dollars and cents, and that's only 2 decimal places. I can show you later on that when we start looking at interest rates, if the interest rate is, you got 3 decimal places over, it's different over here, it's going to make a difference in your calculation. Questions? Okay, so let's talk about, hop up here. Let's talk about cash flow streams, loan amortization, and the value of anything. By the way, present value, future value. Does present value actually have to happen right now? No. Does future value actually have to happen in the future? No. All this means is that future value happened after present value. That's all that it means, so don't let that confuse you. Also, we, in the first set of lectures, which I'm not going to go through here, I tell you an important thing, and that is for the TIBA2+, cash flows in opposite directions have opposite signs. What does that mean for the sign on present value versus future value? Yeah, they're going to be opposite, right? And does it matter which one I put the negative on? No. Okay, so let's talk about some different cash flows here. And the first one is the perpetuity. By the way, the perpetuity, the word perpetual means goes on forever. And so this is a set of identical cash flows that goes on until the end of time. It's really easy to calculate the present value of these. All you do is take that periodic cash flow and divide by the periodic interest rate. By the way, the periods have to match up. So if this is a monthly cash flow, we need to have per month in the interest rate. If this is a yearly cash flow, we need to have per year down here. So that's really the only thing that makes this tricky at all. But if you can't remember this formula, even though you wrote it on your sheet, you can always trick your calculator into doing perpetuities by entering just as many 9s as you can in for n, which is the number of periods. Because it turns out, the further out in time you go, the less and less and less the present value of those cash flows are, because they're so far out in time, they're almost worthless, right? So the difference between infinity and 99999999999 from a present value perspective is usually less than 1 cent. Usually even less than that. So, can we calculate the interest rate on a perpetuity? Yeah, all we have to do is take C over PV. So I would just take the cash flow divided by the present value. So if I'm going to pay $1,000 for something and it's going to pay $100 a year for the rest of all times, I would just take 100 divided by 1,000 would give me 10%. Now, here's the problem. We've got a perpetuity that pays 100 per year. The required rate of return is 10%. What's the stream worth to you? We could easily use the formula and figure it out. That's 1,000. If you just love making your TIBA2+ work, here's what you do. First thing is second future value. Why am I doing that? Yeah, clear. TVM. What does TVM stand for? Time value of money. That's this row of keys right here. Okay, so I'm going to say 100. That's my annual payment. What button should I hit next? PMT. PMT stands for payment. And I'm going to put in 10 I per Y. What's I per Y? Interest rate. And then I'm going to put in just as many 9s as it will let me. And I'm going to put in that for N. That's the number of periods. Now, what would I do to calculate the present value? Compute, that's the button above second, present value. Now, notice that it's negative 1,000. It's because it's a cash flow in the opposite direction, right? So think about it this way. I'm going to buy this investment for $1,000 as a cash flow out. And then the cash is going to come back to me $100 at a time. That's cash flow back to me is positive. Questions? Okay, now a growing perpetuity we can identify by, we have to make 2 changes here. First of all, there's C1. Because all the cash flows are no longer identical, we have to say which cash flow are we talking about. And it's always the one from time 1. By the way, we're discussing the present value at time 0. Go ahead and write a little 0 next to that PV. And we're starting with the cash flow from time 1. Remember, in finance, the cash flows happen at the end of the period unless you're told otherwise. The cash flows happen at the end of the period unless you're told otherwise. What's the other thing that's different here from our perpetuity formula? Yeah, G. What do you think G is?
Growth rate.
Yeah, it's the growth rate. And by the way, R and G are both in decimal form. Do not put them in as percentages or you will be in a world of hurt. Anytime you're using percentages, if you convert them to decimals and you remember what you've done, you will be okay. Sometimes you can leave stuff in percentage and be okay, but not all the time. And so if you are unsure of which you should be doing, always convert things to decimals and just remember that you've done that. An investment company offers you a stream of cash flows that grows at 5% a year. The first payment of $1,000 is due 1 year from today. That's C1. You require a return of 10% on this investment. How much is this investment worth to you today? Well, our C1 is 1,000. Our R is 0.10. Our G is 0.05. 0.10 minus 0.05 on the bottom is 0.05. 1,000 divided by 0.05 gives us $20,000 is our present value. Now, could I have fooled my calculator into doing this? Yes, but it requires one more trick. The N is still going to be a bunch of 9s, but instead of putting in the required return for I per Y, I'm going to put in R minus G. And I'm going to leave it in percentages because that's how your calculator thinks. So it would be 10 minus 5. I would be putting in 5 for I per Y. And then I would be putting C1 into payment. Put C1 into payment. So there are actually, 3 things you have to do here to fool this thing. I prefer just to use the formula. You may prefer to fool your calculator. You need to figure out which one works for you. So an annuity is a set of identical cash flows, which sounds a lot like a perpetuity, except for an annuity only goes on for a limited amount of time. And we're going to talk about 2 types of annuities. We've got the ordinary annuity, which is where the cash flow happens at the end of the period. Remember, we said that's normal or ordinary in finance. And then we've got an annuity due, which is where the cash flow happens at the beginning. If I offered you 2 otherwise identical annuities, one is ordinary and one is due, which one would you take? Yeah, I would take the due. Why? Yeah, time value of money. By the way, hopefully you guys remember $1 today is worth more than $1 a year from now, right? Everything is going to get to you 1 period sooner. Therefore, they're all going to have a greater present value. Therefore, it's worth more to you. So what kinds of things do we see being annuities? Well, car loans, if you've ever had a car loan, mortgages are this way. By the way, how many payments on your typical car loan? How many years typically? 5, yeah. So it used to, 5 for most things. But now you go out and buy one of these stupid $100,000 pickup trucks, and they're like going to give you 7 years to pay for it. Like, give me a freaking break. Okay, so on with the story. If it's a 5-year loan, how many payments? 60. How long is the average mortgage? 30. How many payments? 360. I guarantee you, the first time you buy a house and you look at those mortgage payments and you see those 360 payments laid out, you're going to crap your pants, right? And then when you see how much you're going to pay total versus the value of the house, you're going to crap your pants again. But hey, that's just part of being an American, right? That's what you get. In theory, that's what you're supposed to do. Okay. Not crapping your pants buying a house. Okay. Also, we can use annuities to think about retirement. Now, the formula is complex. Notice I don't include it anywhere in the slide. And I don't think you should have it on your note sheet. And that's because even if you were like me when I first started out, you're like, oh no, I'm going to use the formula. You will screw it up. You will. It's just too complex. You'd have to be some sort of mathematical genius, which apparently I'm not because I screwed it up. So I'm telling you, just lean on your TIBA 2+ to do this. Okay, so here we go. We've got ordinary annuities. We're going to borrow $60,000 for 5 years to purchase a BMW. The interest rate is 6%. By the way, if I tell you an interest rate and I don't tell you the period, what do you assume? Annual, right? We always assume annual. And so we assume this is an APR, annual percentage rate. And if you go back and watch the video, the first video from this deal, you'll see that an APR is just the number of sub-periods multiplied by the sub-period interest rate. And so basically, in order to get to our monthly rate, what are we going to have to do to that 6%? Yeah, divide by 12, and that's going to tell us the monthly rate is 0.5%. Okay, it's asking how much are your monthly payments? So here we go. What's the first thing I do on my calculator? Second, clear TVM. So there's a bank teller here in town, or it used to be. I would drive to her window, and she would say, "Oh, Dr. Haggard," and I would say, "Hey," and her name was Ms. Lucas. And she said, "I still hear you in my sleep saying, 'Second, clear TVM.'" I said, "Good. I hope you remember that until the day you no longer need it," right? Second, clear TVM. What do I put in for present value? 60,000. By the way, does it matter if I put it in negative or positive? No. What do I put in for N? 60, because it's 5 years times 12 months per year. That's 60. What do I put in for I per Y? 60 divided by 12, which is 0.5 I per Y. And I'm going to compute the payment. My payment would be $1,159.97. Why is there a negative sign on that?
Because you left the positive in the present value.
Yeah, I left the present value positive, and it's a cash flow in opposite direction. Does that make sense? Okay. So we figured out how to find the payment. Now, this is when I bought my wife's Hyundai Santa Fe in 2007. Car loan with a 6.35% interest. By the way, is that per month?
Yes.
Per year. Because if I don't tell you otherwise, you are to assume it is per year, right? In fact, we call the APR, we also call it a stated or quoted interest rate. Those would be other names for it. $526.39 a month payments for 5 years. How much did you borrow? So we're going to get our calculator out here. What's the first thing we do? Second, clear TVM. And what should I do with this 6.35? Yeah, first thing I got to do is divide by 12. Now I'm going to tell you, you have to hit equal here. You might assume that you could just hit I per Y. No, you got to hit equal first. And then you hit I per Y. Now, how many payments? 60. And the payments are 526.39. What button do I hit next? PMT, which stands for payment. And now what am I going to compute? Yeah, compute the present value. Now this comes out to $26,999.95. In reality, I borrowed $27,000. I borrowed $27,000. And so what you'll see is that that last payment would have been for an extra 5 cents or whatever the difference is, right? They do get you for that extra. So one of your payments will be a little bit different. Now let's talk about finding the interest rate. This is where it gets kind of hairy. You've borrowed $300,000 over 30 years. What do you think you bought with that $300,000? A house. By the way, back when I wrote this question, $300,000 was a decent house. Okay, so you borrowed $300,000 over 30 years. Your payments are this much. What is the APR on your loan? Let's get our calculator up. What's the first thing we do? Second, clear TVM. What is present value? 300,000. I'm going to hit present value. What's your payment? 3,085.84, right? Now, cash flows in opposite directions have opposite signs. Therefore, because I put in the present value as positive, this one has to be negative. So I got to hit this plus minus, and then I'm going to hit PMT. And then how many payments in 30 years? 360
payments, and what am I going to compute?
I don't know.
Yeah, we're going to compute I over Y. Now, students will often say, aha, I've got the APR. But do you? No, because this is a monthly interest rates. Remember, when we put in monthly payment 360, the interest rate it's going to spit back out at us is a monthly rate. How do I get from the monthly rate to the APR? I got to multiply by 12. You guys probably couldn't imagine 12% mortgages. I remember from my childhood, people having 18% mortgages. Oh yeah. Of course, what happens when the next recession hits and they drop interest rates, everybody refinances, right? Okay. You've borrowed $100,000 at 10% interest. Your payments are this much. What is the term of your loan in years? By the way, this is a monthly payment, so here we go. What's the first thing we do with our calculator? Second, clear TVM. 100,000, what is that? Present value. Let me throw this out at you. You borrow the present value. You always borrow the present value. The present value is the amount you borrow. Okay, now 10% interest. That's 10% per year. So in order to get to a month, which is what we need, what are we going to have to do? Divide by 12. 10. Divide by 12. I've got to hit equals here before I hit I per Y. Now, 13, 21, 51. Let's see. If we put in 100,000 as positive, what do we have to do with this? Got to make it negative. Does it matter which is which? No. And I'm going to hit PMT. Okay, I think we are finally ready to compute N. Is this 120 years? No, it's 120 months. How do I get to years? Divide by 12 gets me down to 10 years. Okay, now let's talk about annuities due. We already talked about what the difference is. I'm going to show you how to make your calculator handle these. We're going to do an example. I'll show you how to do that, and I'll show you how to make sure you get it back, because otherwise the rest of your life will be full of pain and sorrow. Because every other question that's not an annuity due, the answer will be wrong. Okay, so here we go. Your crazy aunt has given you the option of receiving $1,000 per year at the beginning of each year for 20 years, or the same period at the end of the year. The interest is 5%. Which one is worth more and how much more? By the way, do we even have to do a calculation to know which one's worth more? No, which one's worth more? No. The annuity due, right? The annuity due is worth more. Now, let's figure out how to do that. And here's what I would tell you. We're going to do the annuity due first, because we will then have to switch our calculator back to the regular mode in order to be able to calculate the ordinary annuity, and this will leave our calculator set up well to do every other problem I'm going to throw at you. Typically on an exam you'll see maybe one annuity due question, and I typically like to set them up like this to try to force you to reset your calculator, but if you did the ordinary one first, you'd be messing yourself up, right? You want to do the annuity due first. Now, how do I get the calculator to think differently? Well, first thing I'm going to do is clear TVM. And then I'm going to hit second PMT. What does it say above PMT? Yeah, it says BGN, which is beginning. Right now the screen says end. That is the default setting. If I want to change that, the calculator is giving me a hint. What does it say up here? Set. How do I get to set? Do you find set on your calculator? Where is it? Yeah, it's above enter. How do I get to the thing that's above enter? Second. So I'm going to say second, enter. That toggles to BGN. You see the screen change from END to BGN, and one other thing happens here. Check this out. Now you've got this little BGN over here. I'm going to hit clear, and that thing stays there. If you find that your answers are a little bit off, I want you to immediately look up at that upper right-hand corner because you might have forgotten to reset your calculator. And it'll only be off by a little bit, but it'll be enough to mess you up. Okay, now we have a payment of $1,000 a year. 1,000 PMT. How many years? 20. And what's the interest rate? 5. I per Y. And now we are going to compute the present value. And it's going to come out to be negative 13,000. By the way, why negative? Sign change, right? From different directions, different signs. Here's what I'm going to do. Because I know this number is going to be larger, I'm going to hit plus minus, and then I'm going to hit store 1. And we're going to hold on to that number. Now, here's the cool thing. Do you think I need to re-enter all those cash flows and crap like that? No. All I have to do is say second, PMT. How do I get it to change back to end? Second, enter. Now I can hit clear. And all I have to do now is compute the present value. And it comes out to negative 12,000. So all I'm interested in doing is taking that first number and subtracting this number. So really all I have to do is say plus, recall 1, equal. And it tells me that the ordinary annuity is worth $623.11 less than the annuity due. Now, notice my calculator is not set for BGN anymore, so I should be able to get the correct answers to the remaining exam questions as long as I do my work correctly. By the way, would it be good for you to learn how to do the calculator purification ritual during the exam? Yeah, sometimes you won't remember what it is that you screwed up, right? And you won't know how to unscrew what you've screwed up. So, purification ritual. That'll get you back into the ballgame. Okay, uneven cash flows. So far, the cash flows we've talked about, they've been the same. That's not how real projects work. Usually the cash flows are lumpy. And so here we go. What we're going to do is say CF, second, clear work. Look above the CE/C key. What does it say? Clear work. So I'm going to do this again. I see that you're lost. CF, second, and then the clear button. What did that do? It cleared out all the cash flows that were in there previously. And here's why it's important to do that. Because the calculator is like a wife. It never forgets. It never forgets. By the way, that is a wife-approved joke. How do you get rid of you have to clear it out. And the reason I'm telling you to do that is, what if you had previously put something in there that had 7 different cash flows? They're going to be hanging out there just waiting to mess you up, right? Okay, now, I have bad news for you guys. Wives do not have this clear work function, so they remember everything, right? So just don't do stupid stuff. Okay, now here we go. Cash flow at time 0, what do you think that is? Yeah, so I have to say 10,000 negative. I've got to hit enter or it's like it never happened. I've got to hit enter. Arrow down. What is C01? 2,500. Enter. Arrow down. What does F01 mean?
Frequency.
Yeah, it's a frequency. It's how many times that particular cash flow happened. How many times did it happen? 2. So I'm going to put in 2. Enter. Arrow down. What is the cash? Oh, by the way, this is cash flow 2, but we're actually at time 3. Don't let that freak you out. That's the way the calculator's working at. Don't let that freak you out. Now, what do I need to do here? I've got to hit enter. If I don't, it's not going to remember that that's 0, and it won't let me go on. How many times does that cash flow show up? Once. And then, what is C03? What should I put in? 7,500. Enter. Now, to figure out the present value of this, what I'm going to do is select the NPV key. Because the NPV key is just the sum of the present values of the cash flows where positive cash flows are in and negative cash flows are out. That's all it is. And so that's what we're trying to figure out here. What do I put in for I? 7. I get 7 and I hit enter. And then, here's the trick that most people forget. you have to hit the down key and then hit compute. By the way, it tells you up here, compute. And it tells you that the present value of these things all added together is $241.76. So that's how you use the CF key. Hopefully I've convinced you by now you need to work on this chapter 4 practice to make sure that you know how to do this stuff. Okay, now we're going to skip over this, and I want to talk to you just a little bit about amortization tables. You can work through this on your own and figure out about amortization tables, but here's what you need to know. By the way, this is my favorite way to question you about amortization on an exam. And by the way, we have more than one meaning for amortization, right? We've already talked about the one with the oil wells and the forests. This is a different one. We're amortizing the loan, and what happens is as we pay this loan down, we are paying interest on less and less money. So the interest goes down, and the amount that we are paying down in principal goes up every time. Every payment represents both principal and interest. By the way, principal is the money that you borrowed, interest is the rent you're paying on that money, and every payment represents a combination of those things in an amortized loan. So I can figure out how much I'm actually paying for the entire loan by taking the payment amount and multiplying by the number of payments. Does that make sense? And that's one of those numbers that's going to make you crap your pants when you get a mortgage. Because here you are buying a house for $354,000 and you're paying over $1 million for it. By the way, how much is interest? How much am I paying in interest? How would I figure that out? Yeah, you just take that number we just calculated, the number of payments times the amount of the payment, that's the total, and we're going to subtract out the principal. Everything that's left over has to be interest. And so you can quite easily figure out how much interest you're going to be paying by taking the payment amount multiplied by the number of payments and subtracting out the initial amount you borrow. Now, unfortunately, some students don't remember that, and what they want to do is create an amortization table and then add all the interest figures together. These people never finish the exam, right? Because it takes too long. By the way, do you think I'm going to throw you a 5-year loan? Hell no, it's going to be a 30-year mortgage with monthly payments, right? You could do that like this if you know the secret. Payment amount times number of payments minus the principal. But if you have to sit down and figure out a 360 amortization table, you're hosed. Questions? So, I want to leave this with one thought, and then next time we will be doing exam 1 review. And the last thought is that the value of anything is the sum of the present values of the expected future cash flows minus the initial investment. That's it. And so we can use that to find the value of stocks, we can use it to find the value of bonds, we can use it to find the value of a rental house. Questions? Bring your questions for next time. First thing, I will be writing your questions up here on the board, the ones that we're going to work through, and then we will jump on it and work through them. See you next time.